Jimmy, how we doing today?
Jeremy, I'm wonderful. A little cold, but we're here.
It's a little cold out there. -10, -15.
Yeah, somewhere in that range. Cold enough to keep the kids out of school today.
Right. So that makes it easy at home, doesn't it?
Oh, lovely.
No doubt. No doubt. So here we are at the end of January 2026 here doing our market insights for the first quarter. So we got a lot of good stuff.
Yeah,
Let's get into it.
let's do it.
So the portfolio points, volatility's back. Look, volatility has been a thing for a long time, but it kind of took a little bit of a rest in
Yeah.
2024.
Right.
It certainly was back in 2025. We've got some themes, and we'll always be talking about taxes.
You know how I love taxes.
All right. So this chart here looks at things from when Trump was inaugurated in his second term on
Yep.
the 20th of January, 2025,
Mm-hmm.
up until 365 days later here in 2026.
Right.
So volatility is back.
Yep.
You can see that on the screen here. Dark purple line there is the S&P 500.
Yep.
Kind of looks rather mundane from this viewpoint because
Yeah.
the VIX is overlaid here. The VIX is a measure of the volatility,
Correct.
and it looks pretty wild.
It does. I think the thing that stands out to me, yes, there are some crazy spikes. Obviously we see, the whole tariff announcement that happened in early April last year obviously sent, the market sideways for a little bit there, trying to figure out, how to interpret what changes might be, on the horizon. And then things sort of, we took a dip, but we did bounce back relatively quickly. But again, the thing that sticks out to me in this chart, yes, volatility is back. We're seeing, some choppy waters, but it's still moving in the right direction if you're following the purple line, right? We're still, in this time period, you're still, up, well over 10%.
Yeah.
It's just not for the faint of heart right now, right? And to your point before, yes, we had this sort of lull in the volatility in 23 and 24 where it was, below historical averages by quite a bit. It's back. It's normal. It's healthy. But this is why, in theory, over longer periods of time, the stocks earn higher levels of return. It's not, you're not getting linear returns in the market.
It's so well said. We know there's a variety of different reasons here. I'm not going to avoid the elephant in the room. The Trump administration does bring some volatility
Sure.
to the marketplace.
Right.
The White House can drive the market one direction or the other with some of their policies, and Trump's speeches for if nothing else.
Right.
There is that, but then there's other things like we know that we're on a rate cutting cycle now too that started back in September.
Right.
And so we know that when those things happen, when you're rate cutting in a non-recessionary environment, that also brings a year's worth of volatility to follow. So that's a
Correct.
historical fact.
Right.
We're in a midterm year.
Midterm, right. Yeah.
So all these things.
More volatility. Absolutely. More unknowns.
And like we were saying, volatility is not a new feature. So this is a bigger, much broader chart of volatility going all the way back to 1997.
Right.
So you're going to see 25 plus years here. Lots of examples of volatility. Anything that stands out to you?
Just looking at some of the major spikes on the VIX on the bottom part of the graph here. You see, to me, the 2008 spike jumps out, and then the COVID spike jumps out as well. But again, the volatility is not new. It's been around. It's gonna be around, and it's important. Again, look, we always talk about building the financial plan, right?
Yeah.
And the financial plans that we build, we have volatility accounted for. So hopefully, it brings investors the ability to show poise in the face of uncertain times and some of these volatile spikes. But if you don't, we know the irrational instinct is to want to act when these markets get very volatile.
It sure is, yeah.
And oftentimes that's not the action that you should take. Oftentimes doing nothing is better. If you've got a well-constructed, diversified portfolio, based on a financial plan, oftentimes not acting in those moments is your best course of action. So volatility is back. It's, relative to the last couple of years, but it's not new. It's not gonna, ever go away. So, build a plan, be ready for it, and know how you want to respond when these moments, when we see these big spikes.
Yeah, it's as predictable as anything. It's going to happen. You just don't know when. You don't know to what degree. But it's really the intersection here, like you said, of sort of this financial behavior. How do you react when it happens? And then perhaps in some respects, either walking away from it altogether and not acting on those urges, but also maybe there's opportunities too sometimes within it.
Absolutely.
Buying opportunities, or maybe there's buy and sell opportunities through things like direct indexing where you can tax loss harvest. So there's, again, volatility I think gets a bad name. I understand why.
Right. It goes both ways though, right?
It does.
We have volatility spikes in the positive direction as well.
Correct. You could absolutely build a chart like that. Another thing we know is that volatility is tempered by two things: time and diversification.
Right. I mean, our good friend Warren Buffett, right? I think this chart is just, the perfect display for its time in the market, not timing the market, right? I'm not trying to time all in or all out around volatility spikes, right? And as you work your way along the x-axis of this graph, 1 year, 5 year, 10 to 20, if you can allow yourself the ability to zoom out from where we stand currently, and you look at the 20-year rolling periods, there isn't a negative return on there.
Yeah.
Right now, that's no guarantee that we're going to have that, the same thing moving 20 years forward, but that's a should give you some real comfort that this is what we're looking at historically. This chart goes back 75 years, all the way back to 1950. This isn't like a small data set here.
Yeah, they have taken the long view here,
right?
As we know, and what a great shout out to Warren Buffett, who actually did retire at the end of 2025.
Yeah.
So officially, my man's posted up. I think still in Omaha.
Yeah, I'm sure he's still involved somehow.
I'm guessing he is not completely out of the game, but
right.
Yeah.
But again, I just think this is like a perfect chart to shout out Warren Buffett and the importance of staying in the market, being diversified, and allowing yourself to live through some of these more volatile times.
So it kind of felt like at this point needed to look. We're not prognosticators for the market. We don't know exactly where it's going to go, but we did want to show some more historical context in light of what we think is going to be a truism: volatility.
Yep.
And now, let's overlay another piece, which is to say there are really kind of three different scenarios in this chart. There are non-election years.
Right.
There are presidential election years, and then there are midterm election years. We're in that midterm election cycle.
Right.
Which tends to be actually the worst of the three.
Right.
But that doesn't mean it's awful.
Correct. Yeah, no, which I don't think is that surprising that you have this level of uncertainty, right? We know the market is not like uncertainty. And we've picked up some more certainty. I know we're going to talk about the tax bill that was put into place last year. So the market has gained more certainty around the taxes moving forward. But the midterm election is, obviously it has created the worst set of outcomes for stocks. And again, this chart's going all the way back to 1933.
Right.
So this is a very large data set, and not that it has to be this way, but for this year, but just this is what history tells us that it's been.
Well, and your point about the market doesn't love change. The market doesn't care if it's Republican, Democrat, Independent.
Correct.
What they don't like is change. And so what you're seeing oftentimes, thematically in politics, is that you have a presidential election and then you have the midterms, and the midterms oftentimes are a referendum on all the things that aren't going the way that people want them to go, and they oftentimes point that ire at the party in power.
Of course.
Right? And so that means change is inevitable in that scenario.
Absolutely.
So here we are dealing with change, dealing with that market psychology once again.
Absolutely.
But again, if you exclude 2002, 2008,
yep,
2 maybe outlier years,
right,
it's a nice clean 10% return in the S&P 500. That's right on average with a 40-year run average returns for the S&P 500. Maybe a little bit low, but just right on average.
Right, absolutely. And again, we talked about diversification and time on the last slide, right? And this is, we're only looking at the U.S. stock market here, the S&P 500. But again, building a plan, having a diversified portfolio is what we know is, critically important for long-term success.
All right, now we're in the themed section. So we've got 2 major themes we're going to touch base on. This first one here is the international markets. We do like talking about the international markets. We've had sort of a thesis for a while that the international markets were going to perform.
Yeah.
Again, we've said it before. We were probably a little early on that, but better early to the party than late, maybe.
Yeah, right.
And so last year was a great year for the international markets, and that's what the chart's telling you. In the lower 2 lines in purple and orange, that's the domestic market.
Right.
16%.
Yep.
And then you had the international market, both developed and emerging, and they're hovering right around 28%.
Well, I had just been, on the last slide, I ended the last slide. We're talking about, diversification, which we had shown before. This has been, an allocation that has been difficult for clients to maintain, right?
No doubt.
I mean, when you keep looking at the S&P 500 has outperformed the international counterparts for such an extended period of time. At some point, a client has to ask, why do we keep investing in these?
Sure, understandably.
Yeah. But it turns out that we didn't know that 2025 was going to be the year that they would outperform, and by a pretty healthy amount as well, right? I mean, this isn't an insignificant delta here between the domestic and international equities.
It's not.
This is a meaningful difference in the overall return. So again, it comes back to building a plan and being disciplined and sticking with the plan that you have created. But it obviously paid very well to have an international allocation in your portfolio in 2025.
I was just listening to JP Morgan's podcast, and they said about 8% of this outperformance is attributable to the decline in the US dollar.
Yeah.
So again, even if you slice 8% off of it, it still outperformed the US.
Right.
So net of the monetary, the difference in
currency, right? Yeah.
So interesting.
Yeah.
But the currency piece can be that icing on top of the cake.
Absolutely.
So is it a new cycle, right? Are we talking about a new cycle? Because we've looked at this chart before. Simply put, when you look at those gray zones in the chart, those are where the international markets are outperforming the domestic markets. And it used to happen on this kind of semi-predictable 7-year cycle.
Right.
And it hasn't happened.
Right.
In a long period of time, just like what you were saying.
Exactly.
Right?
Yeah, you're going more than a decade of U.S. dominance.
Yeah.
So is this a new cycle? Again, we're not prognosticators, but we did see a 12-month period that the international markets comfortably outperformed our domestic equities here.
So it could have legs.
It could.
Here's another thing to look at is the valuations.
Yeah.
Right. So really want to concentrate on the left-hand side of the screen here. Between these are the average price to earnings ratios there and you're seeing sort of the 20-year average, and then you're seeing with the 2 data points, it's current in purple, and a year ago, January 1st, 2025, in blue. So yes, these have all risen a little bit, in some cases, a lot in other cases perhaps.
Right.
But what's it telling you?
Yeah, so again, I think the thing that jumps out at me here is looking at how high the U.S. valuations are relative to the 20-year average. Now, again, you can make an argument that maybe that 20-year average number is going to continue to creep up because the way the market is constructed now and the companies that make up the largest holdings within the S&P 500 are, their business models are so different, from what we were 20, 30 years ago, right? Much less industrial, much more tech reliant. So maybe there's a case to be made for that average to continue creeping up. But nonetheless, we are, in the U.S. we are, well above, especially relative to the other. You're looking at Japan, the Eurozone, emerging markets, and China here. Those purple dots are all much more closely connected to their 20-year average. All still slightly above, but nonetheless, they're much closer to the 20-year average than where the U.S. is at this point. So, again, valuation doesn't mean that the market is going to snap back and correct you back to the 20-year average the next year. It's not how it works, but it's certainly an important variable to consider when you are rebalancing the portfolio, or if you have new fresh money, where you are allocating it to, and how comfortable do you feel with your allocations to U.S. stocks versus the international counterparts. And right now we're seeing that on a valuation basis, international stocks still look relatively cheap compared to the U.S.
They still look attractive, and comparatively to the U.S., kind of very attractive in that valuation perspective.
Right.
Also, they tend to, if you're looking for reasons to broaden the scope of your portfolio, if you're, let's say you're one of these folks who's 95 to 100% in domestic stocks. The other thing is the dividends are higher on the international side, about 3% compared to about 1.5% in the U.S.
Right.
So it's there's some reasons
for sure.
We're certainly not going to get into the currency piece here. It's just way too technical. But there are some economists saying that the dollar could still remain weak, for the foreseeable future, which has its upshots.
Again, you're going to get the currency tailwind when it's when, like the icing on the cake you mentioned before. If that works for you as a tailwind, it certainly makes those international stocks look even better.
Second theme that we wanted to talk about is that bonds are fixed income. It's a performing category.
Yeah.
It really is. It's we have seen it go through a lot of gyrations over the last 4 or 5 years.
Right.
But this is looking back here at the yield to worst is kind of where you see the boxes, the blue boxes.
Right.
Those give you your yields. They're all in a very nice zone, ranging from basically 4 to 6.5%.
Right.
Not so shabby, really. I kind of look at it as a whole and say, hey, look, if I've got a diversified portfolio of fixed income, I'm getting around 5% yield.
Right. Yeah. And now what's not captured in this, but I'm sure we'll talk about, is you got to understand. We got to remember how do you calculate the return of the fixed income, right? You don't just get the yield that's stated on these bars here, right? If the price or if the interest rates are going down, the price return is actually going to be increasing, right? So you're getting your yield plus the potential for additional price appreciation. So your total return could be well above these targets, and that's what we saw in 2025. Bonds were relatively boring compared to stocks, but boring in a great way. Right. I mean, yeah, you're right. You're getting a 5-ish% yield in a diversified portfolio of bonds, but you were getting an even greater total return. And we're still, at this point, it seems like in a rate cutting cycle. It seems more likely that we'll have a rate cut before we'll have our next rate hike. But coming off of 2022, when we saw that big spike in the interest rates in 22, you were able to accumulate a portfolio of bonds that were yielding a higher number. Now the yield is coming down, but the price return that you got from those, you were very well compensated in 2025.
No doubt about it. Let's take a look at that. So here is the Fed funds rate going all the way back to the early 2000s. You can see exactly what you're saying here. The spike in the Fed funds rate there, and now it's on a downward slope.
Right.
The people are guessing that we're going to have I mean, at least a 25 basis point here cut here in 2026.
Right.
Probably more like 50.
Right.
If you get somebody in there who's, I'm not even going to go about we're not going to have the
political
conversation
side,
about the
right.
political side, but there is an opportunity for it to go even lower. But I think 50 basis points is a pretty safe zone.
Right. Yeah.
And that's going to be additive to your bond return, total return.
Absolutely.
There's no doubt
And look,
about
there's plenty of academic debate, and you see, I do find it interesting listening to the variety of prognosticators and portfolio managers that we listen to. There's a wide range of viewpoints on should it be 25 basis point cut, 50 cut, or maintaining. So there's plenty of academic debate around it. It does seem like the markets are favoring that we're going to see a 25 to 50 point cut, which again, understanding how your bond portfolio is constructed could provide some very much well balanced and risk efficient appreciation in your fixed income portfolio.
No doubt. Stability, ideally.
Yep.
Risk off, ideally.
Yep.
And return, ideally. So those are the things that perhaps your bond side of the portfolio can do for you.
Right.
All right. One big beautiful bill act.
Yep.
It was passed last year.
Yep.
We've previewed this a little bit, and we just wanted to hit some of the high points here for what's going to be enacted here in 2026. So, there's a lot. This thing's very meaty.
Right.
There's a lot of moving parts to it, but here's some high points.
Right. So I would say one of the points that's not captured here that is most impactful from a planning perspective is locking in the actual marginal tax brackets, right? Like we now have more certainty as we are projecting and planning for taxes moving forward. We have much more certainty around the tax rates that are going to be in place for the foreseeable future. But these 4 points here are highlighting some of the most important and most hotly debated components of the bill. So SALT, so your state and local taxes, the $10,000 cap was done for single filers and married filing jointly. So there were plenty of folks that were complaining that a single filer has the same cap on state and local taxes as a married couple.
Right.
Does that make sense? I don't know. But you can only deduct up to $10,000 before. That number's jumped up to $40,000 depending on your income. But that could really have some meaningful impact depending on what state you live in and how high your property taxes are. It could be a significant impact on the amount of deductions that you're able to claim on the return. The estate deduction, right? This is huge.
It is because there's been a ping pong of activity on estate tax, guidance really.
Yeah.
It's hard to predict where it's going. At one point, it was like you could have an estate worth just over $500,000 and all of a sudden you're paying estate taxes.
Right.
Now it's 15.
Yeah, 15 million.
For one person.
For one person, right. So now you've got the portability between spouses, and now you're talking about, nobody that's worth less than $30 million having to worry about estate taxes for their beneficiaries.
Right.
Outside of certain states, obviously have their own, but by and large, from a federal perspective, there's not many families out there that have a balance sheet north of $30 million.
Right.
So if you are above $30 million, congratulations. And you can, work to do some planning work around that. But $30 million lifetime exclusion, pretty darn attractive.
Pretty attractive. And then you do taxes for our clients, right? And so you see the child tax credit at work,
right?
For families all the time.
Yeah, absolutely. So this is, with 3 young kids of my own, right? Like this is something that I appreciate. Seeing that child tax credit number increase, and then a portion of that is refundable potentially. So again, this is something that was hotly debated. I think there's a lot of broad-based support for increasing the child tax credit. I don't think that it was just more a matter of the amount that you would increase it to. I don't think there was a whole lot of pushback on increasing the child tax credit.
I think it's an interesting policy piece too, because at the end of the day, the United States is going to get to a point, especially with cracking down on immigration, where if you're not promoting having children in this country, we're going to have negative growth in terms of population.
Right.
So
that's a great point.
You have to do things that are going to incent people, or at least make it less disincenting to have children.
Right. Now the last one here is probably one of the most impactful here. So there was a lot of talk about no tax on tips, no tax on overtime, and then no tax on Social Security. So what we're highlighting here is the increased standard deduction for tax filers that are 65 and older, and they were not able to actually enact all Social Security income, not being subject to tax, right? What they did was increase, there's a bonus standard deduction. Now it's not in place permanently. This is in place for 2025 through 2028. But if you are a married couple filing jointly 65 years and older, you're now getting $6,000 per spouse, and that's a big way. So that was really how they tried to, significantly reduce the impact of taxes on Social Security benefits.
So if you meet the income requirements,
Right.
and you're a married couple filing jointly,
Yep.
you're going to get an additional $12,000,
which is a very meaningful amount. We've seen it in the projections that we're running for clients and the planning work that we're doing. It's a very meaningful impact.
So that's nearly a 50% increase over the standard deduction.
Correct.
That's really impressive.
Yes.
Okay. Yeah. So there are big things going on in taxes.
Right.
And as much as people snore when we start to talk about taxes, it's actually worth listening.
Oh, absolutely.
Because there is a lot of opportunity. We always say this. There's a lot of opportunity in the tax code for you as personal investors to take advantage of what it gives you.
Right.
And look to avoid the pitfalls of where it can hurt you.
Absolutely.
Well, that does it for taxes.
Love it.
And that does it for this version of the Quarterly Insights. If you all are interested in talking to us, we got our information up there.
Yep.
Happy to field any phone calls, emails, any questions you might have.
Right.
And Happy New Year to everybody.
Happy New Year.
We think it's going to be, an exciting year. We're certainly living in an interesting time.
Right.
There's no doubt about that. And we're excited to see what plays out.
I'm excited for 2026. Let's go.